certain parts you'll say, this is crazy. We gotta talk right into the crazy. Alright, we're gonna get started, but stop me, ask questions. Some parts will go faster, some parts will go slower. One more question, how many of you got employees and running payroll? Okay, because a chunk of this is related to payroll, we can skim over. I'll just hit the real high points on that and not drag you through all the details. The bottom line, you probably want to go get a payroll company running your payroll, because more people get in trouble with payroll and the fines and the penalties and all that stuff adds up so fast. That's us, that's our contact information. We're up at 14 in Alameda. Put some business cards on the back. If anybody's interested, we can give 30-minute free consultation. So if you just want to come by and talk, we have coffee. We'll load you up as much coffee as you want to drink, and we'll try to answer all your questions. Okay, we're going to talk about the different business types. You can be sole proprietor, you can be corporation, you can be LLC, partnerships, all different types of things. Talk about how they work. Kathy maybe give you a little bit of idea of maybe which one you want to be. Different bookkeeping system, record keeping. People always say, how long should I keep that? You don't like it. Employer taxes, tax withholding, filing requirements as an employer, information returns. If you're in business, you're going to send out information. These are like what's called 1099s, different type of forms that you have to fill out. We'll talk about those. Methods of filing, where to get help, and then there's some additional taxes. There's something called a Texas franchise tax. There's a business personal property tax that a lot of people have never even heard of. We have a lot of people that go into business, they've been in business for years, and have no idea there's such a thing as a business personal property tax. So we'll try to talk about those just a little bit. So, you guys are in business. Okay, so proprietors, LLC? LLC? What about you? Why are y'all, everybody's an LLC? Okay.
Time has been business, and you have a lot of work, and then why don't you, get your business started subcontract, okay, and so, I got so much work, it was this, and so, I ran blindly, okay, gotta make up the name, and, then I had to change it because it was wrong. And then, start doing a little bit of work here and there. It's like, you need to get an LLC because you put this in and this and that. And I'm like, oh, go to see, how do I do that? So, that's why, basically, because I went into something kind of blindly, and I'm still, it's been a couple of years, but there was only that 1 year that was real busy this year. I haven't done anything because I thought I'd just take a step back and try to learn what I'm supposed to learn before. So that's why I'm.
We'll talk a little bit about that too. How come you're in LLC? I'm gonna pick on you guys. It's easier than me talking to pick on you
I
guys.
did a small amount of research, but my brother is an attorney, and he recommended that for sure I definitely should.
Okay. All right.
To protect myself, I'm in IT, and if I make a mistake, I don't want them to come after my personal.
Yes, and we'll talk about, but primarily the reason you choose to be an LLC is purely for liability protection. There's not much in the way of tax. Depending on how you go about it, we'll talk, but primarily going to do that for liability protection. We're not really going to talk about nonprofits, but if you guys are interested in nonprofits, we can talk about them. Just hold up your hand and get you started. Are you an LLC? We're going to do that.
Yeah.
Why are you an LLC?
Why am I not?
Everybody else had the answer.
Okay, so I'm sorry. Because I have money that I don't want access to.
Liability protection.
Yes.
Yeah, okay. All right, the easiest thing to be, and what most small business owners are, something called a sole proprietorship. And you don't have to do anything to become a sole proprietor except basically say, I'm in business. You are a in business, you may have to get sales tax and numbers and all of that, but to actually be in business as a sole proprietor, you don't have to do anything other than claim your business. Now, if you wanted to operate under your own name, my name is Joe Smith, my company is Joe Smith, you're done. If you wanna be called, Joe's Bar and Grill, then you have to go to the courthouse and get what's called a DBA, a doing business there, a assumed name certificate, for like $25, so you can operate under that. It is simple. You just say you want, and you are. You guys that created LLCs, created them, every one of you, for liability protection. What kind of liability protection do you get out of sole proprietor? Nothing. So it's easy to get into, and it's easy to get in trouble, not so much from a tax standpoint, but from a liability. So you're a sole proprietor, you're an IT, if you had not made your LLC, let's just make that assumption, something was major wrong with your business, all of your personal assets are now subject to getting sued because of something your sole proprietor did. That's where the LLC protects you. If you have no assets, or if you have a business that is low, almost negligible, ability to get sued, you may want to wait a few years to do an LLC. We have a lot of people that come in, they're kicking tires, I'm gonna sell Mary Kay. Okay, you probably don't need an LLC to sell Mary Kay or something like that, because your chances of getting sued are pretty slim. Plus, if you have no personal assets, I got $50 in cash to my name. If they wanna sue me, tell them to come on down. Those are the situations where you might operate as a sole proprietor. A lot of people do it just until they get started. I operated my practice as sole proprietor for like probably 10 years. Probably shouldn't have, but I did, but y'all got E&O insurance, you got insurance and things to cover. So a lot of people start out that way, but you don't want to stay that way. The bigger you get, the less you want to be this. It's very small, new startup type things. Okay, we're going to talk about the Texas franchise tax later, but if you're a sole proprietor, you don't have to worry about it. So if that's how you're operating, you can get up and leave when we start talking about the state franchise tax. It is going to be subject to personal property tax, which is not a big number, and again, that and franchise tax we're going to talk about at the very end. So if for some reason I try to skip along, you let me know. Don't let me out the ring without talking about it. You might have to sign up for a sales tax permit, depending on what you're doing. If you're selling a product, you're going to need to report sales tax. If you're selling your service, if you're doing IT services, if you're doing dog walking, if you're doing something, then you would not need a sales tax. Okay, how are they taxed? Anybody, you guys that are LLCs, did y'all used to be sole proprietors? How hard was it to do the tax return?
This is my first year, so
First year, okay.
I've only been doing it since April, so.
I know. Okay. Sole proprietor taxation is very, very simple. It's all filed on your personal tax return. How many of you guys file your own tax return? You don't, do you? If you do, we're gonna, help you. You got your 1040, okay, and if you look on your 1040, there's W-2 wages, there's interest, dividends, there's capital gains. One of those is income from self-employment. That's where your sole proprietor income shows up on your personal tax return. Okay, you actually complete a form called a Schedule C, like in CAT. That outlines the profits and losses of your sole proprietor. Whatever the net is after all expenses, that's what goes on your 1040. It's actually pretty simple in an early stage, but as you grow and you get assets that are being depreciated and you get retirement plans, it gets a little more complicated. But the joy of being self-employed is you get to pay not only income tax, but you get to pay self-employment tax. So those of you who work for somebody else, if you look at your pay stub, they withheld Social Security and Medicare out of your check. What you don't know is company puts that much more. The company doubles it, so if they took $10 out of your check, the company puts in another $10 and $20 goes into the Social Security Administration. Well, as a sole proprietor, you don't have anybody doing the doubling and all that, so you pay 15.3% of your profits as what's called self-employment tax or Social Security Medicare tax. Plus, you pay income tax on top of that. So it's not unusual for a sole proprietor just starting out to be paying 25–30% tax on the bottom line. Just be prepared when you do that. A lot of people are shocked. There's ways around it when you start making more money, and we'll talk a little bit about that. But basically, that's what's going into your Social Security, that's what's going into your Medicare, whether you believe it's going to be here or not when you retire, that's your issue. Some people want to put money in there so they know they got it when they retire. Other people, I don't want to put any money any more than I have to. So anyway, that's a sole proprietor. Pretty simple. When you stop being business, a sole proprietor, you just step back. I'm done. And you walk away. Very little to close to. Any questions? That was easy. Somebody's asleep? Yeah, this is good. We're doing good. General partnership. This is something you do not have to do. You know the big red circles with the line through them? We need to have one up there. This is basically a sole proprietor with 2 or more people in it. Okay, so a sole proprietor, you take the step up and says, I'm in business. A partnership is 2 or more people step up and say they're in business. Okay? So you take the liability issues of the sole proprietorship and now you double them, triple them, quadruple them, whatever in a general partnership. So I'm going to pick on you because you're already in business. You and I go into business, right? And we create a general partnership. Guess what? I mess up something in the business really bad, not your fault, you still get sued. Okay? If everybody in this room, we're all in general partnerships together, and I mess up something, everyone in this room can get sued for something I did. That's why we say you typically don't want to be general partnerships. Not with the other options that you have. The people that we see that really come our general partnerships, they don't realize they did it. You know, my brother-in-law and I went into business and we bought a building and we're going to rent it out. General partnerships. You got 2 people in business together. So be real careful that you don't do it. Anyway, this is something you don't want to be. You don't have to pay the franchise tax. You do pay self-employment tax. You do pay property tax. You may or may not pay sales tax. And this one files its own tax return, Form 1065. So a partnership has to file its own unique tax return, but it doesn't pay any tax. So again, we're partners. We make $100 profit off the partnership, and we're 50-50 partners. I pay tax on $50, you pay tax on $50. So you may get to pay tax on money you never received, because the partnership doesn't have any cash, you and I still got to pay tax on the $50 a piece. Not always the most wonderful situation. Anyway, don't do that. Whatever it is, just don't do that. If you find yourself doing that, slap yourself on the hand and stop. Okay, so if you want to be a partnership and you want to get around all the liability issues of a general partnership, there's something called limited partnerships. Most people, you've heard of them, you may not realize you have real estate deals going down. Big chunk of those are limited partnerships. So a limited partnership is a partnership that has certain partners that have limited liability. They're only liable for what they put in. And then you've got a general partner that has to be 1%. The general partner is the one liable. So everybody in this room, we're going to go build what are we going to build? A small office building, okay? We're going to create a limited partnership to do this. I'll make you the general partner, because I don't happen to all of us is we lose $100. If the place goes wrong, it falls down, worst case, we all lose $100 apiece because we're limited partners. He's the responsible partner. Therefore, if you do a limited partnership, you want to create a corporation to be the limited partner, or an LLC to build your protection, so that everybody in the room now is protected from liability. Most of us are not going to be one of these just because typically you create two corporations or two entities. You've got to keep them going. It's expensive. You generally want attorneys to create these things for you. $3,000, $4,000, $5,000 attorney fees to get them all set up and established, and they're kind of hard to keep up with. You need to hire accountants to keep up with it. So I love it. If you guys want to be one, call me. But they are going to pay the state franchise tax because it's an entity that provides legal protection. Anything that provides legal protection is going to be subject to the state franchise tax. We'll be subject to personal property tax, maybe sales tax. It files the same tax form as the general partnership. Just a different box you check. It says I'm a limited versus a general partnership. The limited partners don't pay the self-employment tax, so everybody in here, we're cool except for you. You're stuck paying them. But if you've got a corporation, you don't have to worry about it. So, anyway, this is a good thing to be if you've got liability, if you've got investors, if it's just you running your own little business, you don't want to go this route either. Okay, there are two terms of C corp. We got one. You want to learn about it? Or you don't want to learn about it? Okay. A C corp is the types of corporations that have been around forever. When you think of a corporation, you think of all the guys on the stock exchange, IBM, and Dell Computers, and General Motors, and AT&T, all those are C corporations. So a C corporation sells stock. So the owners of a C corporation are the stockholders. So therefore, that's why when you go on the stock exchange, you want to buy stock in IBM. That's how it works. You own a little piece. They got 1 million shares, and you buy 1 share. You own 1/1,000,000th of General Motors. C corporations isolate the shareholders from any liability. So again, since we're all friends now, we're all going in together, and we're going to start C corporation. We're not required to have a general partner like you are in a limited partnership. We can all be shareholders, and none of us as shareholders are subject to being sued. We just own a percentage of the stock. The ones that get sued are the officers. No, we pick on her now. Okay, we're going to pick on you since you want to know. You're the president of the company. Okay? Sounds good. You make all the decisions. Something went major wrong. You created a product, you sold it to General Motors, put on their cars, it caused wrecks all over the country. As a stockholder, you're good. You can't get sued. But as an officer of the company, now you're going to get sued. So shareholders are cool. It's the officers of the company that need to take care. You're going to need all kinds of officers and directors. Insurance company should provide all that. Insurance is what's going to protect you. That's your there. A C corporation pays its own income tax. All these other ones we're talking about, not any of them pay their own income tax. They all pass it through. A C corporation actually pays its own income tax. So when you hear the politicians saying we have the highest corporate tax rate in the world, they're talking about C corps. And the rate does like this, but generally it's 35% tax rate of the profits. That's a pretty high rate, honestly. When you look at rates across the world, they're taxing somebody 35% of their profits. Where if I can go, and I'm not trying to be political, but if I can move operations to Puerto Rico and pay 10% tax, why wouldn't I? not our job, I guess, to figure the tax rates, other than our job is to pay them. But, it files its own separate tax return, 1120. Like I said, it pays its own tax, income tax. It's subject to something called double taxation. Y'all heard of that? Okay. Corporations pay dividends, right? C corp, so if you own stock and somebody on the stock exchange, you're hoping they pay dividends, 20 cents a share, 5 cents a share, whatever it is. The corporation pays tax on the money that's available for the dividends, because a dividend is not a deductible expense to a corporation. So if the corporation makes $100, they pay tax on $100. If they want to take that $100 and then give it to the shareholders pay tax on that $100 again. That's your double taxation. The corporation pays tax on it and the shareholders pay tax on it. Smaller C corps, you can get around it by paying things out in salaries and different things, but the bigger ones are getting hit with the double taxation, and there's not a lot they can do about it. So did I answer any of your questions about C corp? Okay. If you are, generally, we don't want to be a C corp because of the tax rate. They're very rigid as far as what you can do. You can't put money in and out very easily. It's got to be very formal. But if you're a foreign national and you want to own a U.S. company, generally we recommend that you be a C corp. So if you're from, I was talking to a guy yesterday from India, that he's going to create a company in India, a corporation, that's going to own the U.S. corporation. There's estate tax reasons and different things. So if you're a foreign national, you want to own a U.S. company, C corp is a good way to go. And if you ever heard of these situations where people could take their retirement plan and you roll it over and use it to fund your own business, those are required to be C corps. I forget what the name of it, but those are all required to be C corps. So if I didn't answer your question, tag me in. Okay. S corporations. Isn't this exciting? This is like the greatest thing I've done all day to learn about. Yeah, we're sick that way. S corporations are a different way to pay taxes. You don't create a corporation. You don't create an S corporation. You create an LLC. You create a C corp. You create something, and then you tell the IRS, I want to be taxed as an S corp. So it's purely a taxing election that you make with the IRS. It's got the same restrictions. It's subject to state franchise, personal property, maybe not sales tax. It is not subject to double taxation. It has its own tax form, 1120S, but it passes through to the shareholders the profits or loss. So like we said, the C corp is the only one that pays its own way income tax wise. And the S corp spreads all those profits and losses down to the shareholders. So for 60-40, I get 60% of the profit or loss, you get 40, purely based on the number of shares, percentage of shares that you own. There is, and I have a hard time explaining how there's a tax advantage on the self-employment taxes for a S corp. So remember we talked about sole proprietors, you got 15.3% self-employment tax. Partnerships, you got 15.3% self-employment tax. Even in a C corp, if you pay yourself salary out of a C corp, you're incurring 15.3% self-employment tax. It's still in there. An S corp allows you to take part of your money, if you're an owner, out of the business. That's what's called a shareholder distribution, and that amount is not subject to Social Security Medicare tax.
But you still have income tax.
You still have income tax, correct. Only thing that's buying you is a less in the 15.3% Social Security tax. So let's take an example that says the required to take a certain amount of salary. That amount is kind of a gray area. Whatever you pick, the IRS is gonna say it's not high enough. It's just, that's just the way the game works. So, we like to say, you need to take $35,000, $40,000 to $50,000, depending on what you're doing as a salary, to prove that we're paying in our fair share to the Social Security Medicare. So for math purposes, let's just do $100,000 profit. I pay myself $50,000 in salary, of which I pay Social Security Medicare on. I take the other $50,000 as a shareholder distribution. Still pay income tax, but I just say 15.3% of $50,000, which is what, $7,600? Anybody's got a calculator? I just say that by being an S corp, by taking my pay in two different chunks, I save myself $7,650, I believe. Okay, that's that much less.
How's that legal?
It's legal.
But
It's allowed in the tax code.
as an S corporation, because you distribute money to yourself, and you can use that money if you pay income tax, but you don't pay.
Like in our example where you have 100,000 profit, you pay income tax on the 100,000. And then the part I take is salary, pay Social Security Medicare on the part I take withdrawal is total. So it doesn't affect the income tax. You still pay your income tax. It's just a way to avoid Social Security Medicare tax. Congress is well aware of this. Every few years they come back and say, we're going to get rid of that, and never have. So right now, and for the foreseeable future, this is still a viable alternative. They may take it away from us someday, but right now it is entirely legal. And lots of people use it. I am an S corp. This is how I take my pay. I split it 50-50 basically between salary and non-salary. That's the benefit of an S corp. So if anybody ever comes and asks you, you now know the benefit of S corp, you can explain it to them. Right? Yeah. Okay, LLCs. This is what everybody does. When we did the survey, nobody was a C corp, nobody's an S corp, nobody's a partnership. Everybody that was already in business in here is a LLC. And I will tell you that an LLC really does not provide you much in the way of tax benefit. If it is, it's negligible. The whole sole purpose you want to be an LLC is liability protection. And I'm not an attorney, but I talk to attorneys. A lot of times we have an attorney that he and I do this class together. And what the attorneys tell me, and you need to go verify it with your attorneys, is the LLC provides the best. You're an attorney? They provide the best liability protection of any of the entities that we've talked about. And you say, why? Well, the answer that I get back from them is primarily like a case law issue. C corps have been around forever. S corps have been around a long time. The lawyers that will sue people inside of those know all the little nooks and crannies. They got case law that says, oh, you can go do this and you can't do this. There's not a lot of case law yet on LLC. There will be. But right now, it's still, the ways to get in to break it up are not identified as much. I'll leave the rest of that up to the attorneys to explain it how. And then also, if you do get sued and you do lose, there's something called a charging order, which keeps the people at bay even though they won, still allows you to pay yourself salary and stuff. But again, those are legal questions. I don't want to get into those. Really don't save tax money. You remember it, the LLC is purely for liability protection.
So can't that file as a S corp?
It can. Yeah. You're good. You're setting this
That's
up.
my plan.
Okay. The beauty of an LLC is you can decide how you want to be taxed. Okay? So if you have, I'm assuming you guys are single owner LLCs. So if you're the only owner of an LLC, don't say anything, you're gonna be taxed just like a sole proprietorship. That's what the IRS expects. If you got 2 or more owners of an LLC, you're taxed as a partnership. You file Form 1065. But if you want to be taxed differently, all you gotta do is file the forms. You can be an LLC taxed as a C corp. You could be an LLC taxed as an S corp. You just fill out a piece of paper, send it to the IRS, and tell them how you want to be taxed. A lot of people, probably 80% of the new LLCs that we work with, will immediately make S corp elections.
Yeah, they send it to you, you put your
Yeah.
EIN.
And then, when you do, you get back a letter from the IRS that says you're approved to be an S corp. Now, you don't have to do it at the beginning. You can elect to be an S corp. You could be an LLC taxed as a sole proprietor for 5 years, and then say, you know, I want to be an S corp now. You can do that. Once a year, you have the opportunity to actually make that S corp election. So it's January through March 15th. So what year are we in? 16? If I want to be one for 2017, I've got January through March 15th of 2017 to make that election to be an S, be taxed as an S corp for 2017. Get the numbers mixed up. Okay? Any questions? We're
Well,
through
you
the
have to-
recording part. We're going to get to the exciting.
You have to change to a S corp, right?
Yes, you have to actually file an S corp election with the IRS. And you can't just change in, change out, change in. When you do, it's like a 7-year commitment before you can reverse it back out. We have gotten people out of it by figuring out ways they were ineligible and they shouldn't have done an S corp election up front. But that's kind of hokey. We can do that. Unless it's true. Okay, any questions? Okay. What?
Somebody did say, which I understood, you reiterated that as an LLC, that entity could file as an S corp. But then you just said you can't flip back and forth, so I'm confused.
You can't every year. You can't say, I want to be an S corp for 2017, for 2018, I want to be a sole proprietor, for 2019, I want to be an S corp. You can't jump in and out.
But if your entity is named, as a entity of LLC, but for taxation purposes, you can do an S corp.
Right. You're still an LLC, I'm sorry, maybe I'm
Yeah,
not,
that's right.
you're still an LLC from the state, from the legal protection standpoint, you're still an LLC. None of that has changed. You're just being taxed for income tax purposes as an S corp. Does that answer?
Yeah.
Okay.
And how
I
do you?
probably said it backwards, but yeah, you do not cease being an LLC by making a sub-S election.
And how do you do that, to be taxed as an S corp if you're?
It's a form you file, it's a form, I think it's a 2553 you file with the IRS.
Between January and March.
Between January, you got till March 15th.
So you don't have to go and change your LLC?
Your LLC stays exactly the way it is. Yeah, I misspoke, but probably didn't come across clear. The legal entity does not change. The S corp is just how you want to be taxed. But the nuts and bolts, the legal entity, never changes.
So you file that year for your taxes. You file the beginning of the year to file for that year.
We file it from January to March of 17 for 17.
For 17, to
Correct.
file on, of course, the 18.
And then you're that way forever on until you reject it or revoke it.
Well, how long is the LLC good for? Do you have to reapply?
They're good forever. You can, when you create them, make them for a specific period of time, but 99% of the ones I see are forever until somebody shuts it down.
And then you'll get something in the mail saying it's ready to expire.
Yeah. But since it doesn't expire, what happens, well, so this is our first tangent, this is good. So if you create an LLC, and you guys that have them, you've created this, and you decide you're gonna go out of business, you need to go shut the LLC down. You need to physically file the paperwork to close it down if you want your legal protection. If you want to, if you don't close it down, this is what the attorneys tell me, you just let it expire, because it will expire with the state. I'll tell you how that works in a second. Your liability protection does not no longer protect you after that time period. I may be saying it wrong. So we're gonna, wait a minute, you're good to go. Create your LLC and you go out of business. You want to wrap that thing up. Anything associated with that business, you want to keep that liability protection. So you go through a process. You close down with the Texas State Controller. You close down your sales tax number there. You close down your franchise tax account. They give you a certificate that says, basically it's a certificate of good standing, which says everything with the controller is clear. You then go file with the Texas Secretary of State articles of dissolution or termination, and you actually legally close the thing down. So anybody that had a legal issue with that company now can't mess with you. You went through the process. If you just walk away and you don't file your franchise tax return every year, what they tell me, and I don't know if it's true, is that basically legal issues from that company, you're not protected from them because you didn't close it down correctly. So a lot of people just walk away, and it's probably not a good idea. The filing fees for the articles of termination are like $40, not much. You can do the controller stuff yourself, or you can hire somebody like us. We're generally charged to do the whole thing $400 or something. But we'll get it all closed down, all the forms filed, and then you don't worry about it.
Excuse me, you were saying that the LLC expires with the state?
Yes.
Can you elaborate on that?
Well, to keep an LLC operating, you file an annual franchise tax report, which we're going to talk about it towards the end, to stay in good standing and to keep your liability, because you created an LLC for liability protection. If you don't file your franchise tax return, if you don't keep your papers current with the state, then you lose your liability protection.
Don't worry, they'll find you.
They'll find you. But you get, I mean, if you don't file the return, you're gonna get letters in the mail saying, hey, we didn't get your return. And before they ever terminate, if you did get it terminated, it's not really hard to get it reinstated.
So the franchise tax is your renewal for that, for the LLC. The franchise, paying the franchise tax acts as a renewal for the LLC with the state.
Yes.
Okay, okay.
And you'll know that you really don't have to pay unless you've got sales over $1 million. You just have to file a couple pieces of paper, very simple.
Is that with an S corp also?
I'm sorry?
Is that bought in with an S corp?
Any entity that provides liability protection, C corps, limited partnerships, LLCs, trusts, some of those things, almost all of them are subject to having to file a franchise tax return annually. If you don't, then you lose your protection.
And that basically covers liabilities against the corporation.
Any other questions? Don't get me off on tangents. We'll just skip the whole thing and we'll go off to our crazy stuff. Okay, different kind of bookkeeping systems. You need some kind of bookkeeping system. You want to keep your personal records separate from your company records. You do not want to run your company's business through your personal checking account. IRS comes in, and someday you'll get audited. Don't worry about it. Someday it'll probably happen. And if if they see that business and personal are commingled, they lose any confidence of you being able to identify what's really a business expense versus what's a personal expense. They then pull everything. They pull all your personal, they pull all your business, and it's not fun when they do that. If you have everything, you've got an LLC, separate bank account, purely for the LLC. Have it established under the LLC's name, with the LLC's federal ID number. Don't pay personal bills out of your LLC. Transfer money out of it to your personal account to pay your personal bills. Don't pay business expenses out of your personal account. Transfer money from your personal account to your business account, and then pay the business expense. It's just keeping everything clean. And I guarantee you'll be glad you did when you get off. So single entry bookkeeping is purely like keeping up with a checkbook. Very simple. It may be like an Excel spreadsheet. A lot of small businesses start out and all they have is Excel spreadsheets. It works fine for a little while, but when you get a little bit bigger, it doesn't work quite as well. Double entry bookkeeping has debits and credits. How many of you guys went, you had to take some kind of accounting class in college, or they taught you debits and credits, and you never knew which one was which? Most people are like, I don't know. But even those of us who do this, the first couple of years, we didn't know what they were, so we ended up having to learn. But the easiest, this is from our experience, double entry system uses QuickBooks. There are other systems out there. There's some new internet-based things. I don't even know what they're called, but I'm not familiar with them. 95% of our client base uses QuickBooks. We do recommend you get a little bit of training though. You know, you see on TV, QuickBooks is easy to use, yeah, but it's easy to put it in wrong and to get the wrong information. We always recommend go to a class, get a little bit of training, just so you know how to enter a bill. How do you pay a bill? How do you pay your checks? How do you run payroll out of it if you're going to use it like that? It's well worth the money. So also don't buy, and this is again from our experience, QuickBooks dash electrician, QuickBooks dash whatever. Generally, we say don't buy the dash because 99% of the functionality is exactly the same as the QuickBooks Pro. So our general recommendation is buy the QuickBooks Pro and get it for a couple $100. That's a desktop version. QuickBooks will also try to get you to buy an online version. The desktop version has 2 to 3 times the functionality that the online version has. Online version, they're going to charge you, what, $20, $30 a month forever with less functionality. The only time we recommend using the online version is if you're out and about. You're scattered out. You got one person that works in Denver, and you got one in San Antonio, and one in Dallas, and you all need access to QuickBooks. Then the online version kind of makes more sense. But if you're in the office, everybody's in the same office, and you can work off one computer, then you'll get more functionality for a cheaper price just using the desktop version. And I do not work for QuickBooks. I don't get commissions from QuickBooks. So that's honest opinion. Okay. One thing you need to think about when you file your tax return and when you do your books, there's something called a cash basis of accounting, and the other one is called the accrual basis of accounting. And I know you didn't sign up for an accounting class, but you gotta sit through a minute or two. Cash basis accounting means it's not income to me until the money becomes available to me. So, if I do work for somebody in December, if they pay me in January, that is income December. Right, 'cause that's when I got paid. When did I get the cash? It's called a cash basis. The expenses work the same way. If I pay my bills in December, it's a deduction in December. If I wait till January to pay the bills, it's a deduction in January. So cash, that one's not too complicated. Most people use the cash method of accounting for income taxes. It's just easier to keep up with. The other one is called the accrual basis of accounting. And that means it's income to me when I earned it. So if I do work in December and I invoice you in December, I have to pay income tax on that. Or I have to treat it as December income because that's when I earned it. If you pay me January, February, March, a year later, whatever, I still owe tax on it in January because it's income. Okay, the opposite of that is the expenses. I can deduct expenses when they're incurred, not when I pay them. So again, I get a bunch of bills in December, and they're all for December. I can deduct them all now and pay them in February. So when you're doing tax planning and stuff like that, it's important to know if you're on the cash or accrual. But again, most small businesses are on the cash basis. It's just easier to keep up with. It's less confusing. One thing is once you make an, I mean, you don't, when you start your business and you fill out your tax return the first year, you check the box as cash or accrual accounting. You're not supposed to change that. To change that, in theory, you need an IRS approval. They got a form that's got like yay thick that you have to fill out.
Isn't cash more like you're paying taxes once a year versus accruing, you make enough money that you should be doing it quarterly?
Not necessarily. You're thinking about paying income tax in. I'm just talking about bookkeeping.
I know, I was just thinking that even though I didn't make any money with my LLC, the controller was saying, are we gonna file quarterly or are we gonna file?
Well, the
yearly?
controller's interested in sales tax.
In the tax, yeah.
So they base that on what they anticipate. When you fill out the form, you tell them what your anticipated sales are. And then they go, oh, that fits in the category of you need to be filing the sales tax, either monthly, quarterly, or annually, depending on your sales volume. You can pay on your sales tax. You can elect to do them on the cash pay basis or the accrual. So,
It's not getting it, but okay.
Typically, once you hit $5 million in gross sales, the IRS requires you to be on the accrual basis of accounting because you're considered a big person now. So if you think your company's going to grow to over 5 million, you might want to start you out on the accrual basis. Just don't have to go back and change it later on. Okay, so here I'm going to give you some really precise IRS definitions. If you have an automated system, then it must produce sufficient legible records to determine your direct tax liability. And then the heck knows what that is. I don't know what that is. Records must be sufficient to substantiate items of income, deductions, and credits. Again, what the heck is, they're so vague, and they're leaving it open, obviously, for you to be able to keep books any way you want to. But let me just give you some examples. I think we had 4 clients audited this year. We went years without any, and all of a sudden they've just popped up. But if you're using QuickBooks, the first thing the auditor wants is give me a backup copy of your QuickBooks. And they're going to map that QuickBooks into the tax return. So if you're using the QuickBooks, it needs to match what's in the tax return. So what we do, our clients, they give us a backup copy of QuickBooks. We'll do the tax return. We'll make adjustments. And we will make those adjustments back on their QuickBooks so that when we're done, their QuickBooks matches what's on the tax return and the numbers all tie out. The other thing they're going to do is pull every bank statement for every account that you have. business, generally you can limit them to pulling the business. If they're auditing personal, a lot of times you can limit them, but if things are like this, they're gonna pull every bank statement that's personal, every bank statement that's business. And they're gonna identify every deposit on both of them and claim it's income unless you can prove it's not. So if you got a check from grandma for your birthday for $25, somewhere in there you need to write, this is a check from grandma for my birthday. Keep those records around, or else if you get audited, they'll claim it's income. If you travel, keep records. Let's say you're going to Vegas. None of us have ever gone to Vegas for a seminar. But if we were to go to Vegas for a seminar, you need to be able to prove that you were actually at a seminar. So, they give you a, what do you call it, a syllabus. You know, here's what we're gonna talk about, here's the seminar, these days, this hotel. Keep all that as your backup to prove, you were actually there. Now, if you wanna stay over an extra day or two, okay, but theoretically, your business trip stops when the seminar's over. If you stay over 2 or 3 extra days, those are personal, so you need to separate out your expenses. If you take somebody out to eat, which we all do, business expense, business entertainment, nothing wrong with that. Document, I took Joe Smith, Joe's Bar and Grill, and here's what we talked about. Just document the fact that this was a business meeting. Yes, sir.
Is the IRS, a lot of the receipts now fade. Someone was telling me that you need to start scanning them.
Yeah, they'll
in order-
accept scanned stuff, so.
Okay.
Especially these little receipts, within 2 days, they're faded almost, they're
Right.
terrible.
Do you still need to
Take
keep,
them back and scan them.
it's probably best to keep the originals as well.
I've never had a problem with IRS accepting scanned documents.
Thank you.
IRS can go back as many as 5 or 7 years, so you probably are doing better with the scan product, because like you said, it fades.
Okay, do you know what form, PDF, JPEG, as far as the scan
Anything,
did?
as long as you can pull it up and they can look at it.
Okay, all right, excellent.
And what you'll end up doing is printing it out and giving it to them. They want to see it all on paper generally. Okay, any questions about record keeping that type? Because now we're talking about how long do you keep them? Once you file a tax return, when the date is filed, the IRS has 3 years. This is a personal return. The IRS has 3 years to audit that return. Rarely do I ever see them audited in the first or second year. It's always about 6 months before the time period's up, they show up and they want to audit it. So don't get rid of your records. Just to be safe, we suggest you keep personal records at least 5 years. Business records closer to 7, just to be safe. There are exceptions that they tell me employment records is 4 years, employment tax records. Anything related to the basis of an asset. Let's say you bought a building in 1950, and you still own that building, and you sell it in 2017, you still need to keep the cost records of that building until you sell it, plus about 5 years. Because you've got to be able to prove, if you're audited, what did you pay for it, and the only way to do that is keep the records of when you actually bought it. If you want to change your accounting method, that's going from cash or accrual or whatever, you can keep those records indefinitely. If you have any, you don't see them too often, what non-deductible IRA contributions. There's ways you can get money in the traditional IRA that was not deducted. Therefore, you need to be able to prove that when you take it back out, that this money has been previously taxed.
And then again about indefinitely,
Does what?
you said something about
The change in accounting method.
changing.
So if you're a corporation or an LLC, theoretically these things last forever until you shut them down. If you do an accounting change, you need to keep all that change in accounting method paperwork. Okay. This is important. If there's nothing else you learned today, kind of pay attention to this part. This is determining whether somebody you bring to do work for you is an employee. You have to hire them on your payroll, or can you just hire them as a contract labor, whatever you want to call it. The IRS has done some studies recently and determined the biggest tax cheats out there for individuals that do contract work for others. Their studies and their minds says these guys never pay their taxes. So instead of going after them, what they go after are the companies who hire them. So they've started, these rules are not new, they're just enforcing them more than they ever have. We're seeing a lot of this right now. So we came up with something called a trick. This is just something we came up with. It's not legal. It's just a way for us to keep in our minds, is this person really a contractor, can qualify for a contract, or do we need to make them an employee? So the trick stands for tools, risk, integration, and control. A contractor provides tools of the trade. So if I need to hire a plumber, right? That plumber is going to come with his truck, it's going to be loaded with tools, he's going to have spare pipe. The plumber, in that case, is providing the tools of the trade. If I bring in an individual to sit in my office and do bookkeeping, I provided the tools of the trade. I'm giving them the desk, I'm giving them the computer, I'm giving them all of this stuff. So, and these are not black and white. This is a big gray area, and you kind of have to weigh all this out. Tools of the trade, generally a contractor will provide their own tools. Risk is who's accepting risk. If I'm paying somebody $10 an hour for their work, that individual has no risk whatsoever of losing money. They're getting paid $10 an hour. If I hire a computer guy to come in and fix my computer system, I said, how much it's gonna cost? He says, $1,000. I said, go for it. And if it cost him $5,000, it's not my problem. He gave me a quote, a bid for $1,000. So in that case, the computer guy bears the risk of loss. Somebody you're paying by the hour does not. Integration is basically how important is this person to your business. If the person went away, they're in there for a week, turn around, they're gone. I'll tell you a story. We actually have companies we work that are international companies and stuff. They had the president of North American operations, they had him as a contract laborer. No. He was truly integral to that corporation. He lived and breathed, and everything happened through him for that corporation. He was an integral part. So that's what you want to look at. And then the biggest one is control. If we bring somebody in the office and we say, you sit here, you get up you're here at 8, you can break here, you can go lunch here, this is how you do it, here's the processes, you tell them everything to do, how to do it, that smells like an employee. A contractor, on the other hand, should know what they're doing, they'd already be trained up, they have their own tools, they come in and do a job typically and leave. And so, we kind of talked about all those. And then you weigh it, because there is, one could meet one criteria and not meet another criteria. IRS has like a 21-point test. Texas Workforce Commission has another one. And they ask question after question after question to try to get there. So don't live and die off the trick. That's just something we came up with to help us. But what if you get it wrong? What can happen to you? Let's start with, if you hire somebody as a contractor and they should have been an employee, and the IRS comes in and does their evaluation and goes, sorry, these guys were employees. you didn't do them right. The employer is responsible for all the taxes they should have withheld from the contractor and didn't. Penalties, interest. As an employee, you're required to get an I-9 to determine if the person's legal to work. If you don't have an I-9, there's $11,000 fine. The fines and the penalties just start pouring in. And then you got interest, penalties on top of that. We've seen people come in owing hundreds of thousands of dollars because they misclassified people. So a lot of our clients just, I'm just gonna hire them as a contractor. We sit down and we go through this with them and said, you know, okay, but you need to think about these things. If you want to hire somebody as a contractor, build your case beforehand. Okay. You're so good to pick on. I'm gonna pick on you. I wanna hire you to be a contractor for me. What I would like for you to do is create a company. You've got an LLC, that's good. LLC cannot be an employee. So I'm going to hire you. I want you to send me invoices under the letterhead of your LLC. I don't want you to give me a timesheet. I want you to send me invoices. We're gonna have a contract that says that you understand you're a contractor, and that it here defines our relationship. We build all these pieces up front so that if we do get audited, it's almost impossible for them to claim you're an employee because you're invoicing me for milestones, for work done, you've got your own company, da 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 da. Where you get in trouble is you hire Joe Smith, an individual with a social security number, you know, and they're just hanging around. So,
But you're really transferring the responsibility to pay taxes.
to him.
To him.
Correct.
You're protecting.
I'm protecting in this case, I am protecting myself.
Does that fall under my general liability, my contract? Or would that?
Oh, that I don't know. Yeah, that's an insurance question. I really.
Or would he be needing to have?
Well, what I see in construction and stuff, the subs, don't they have to provide their own general liability?
But if I hire someone like yourself, a mechanic,
Yeah.
come in, and you have to have some type of liability insurance or anything like that?
I mean, I've got liability insurance, but I think that would be up to you to require that. If you just hired me to come in and you didn't require me to have insurance or not, I could come screw up all your stuff.
Right.
And then you can sue me, but it gets back to good luck with that. Yes, ma'am?
So if I hire you and you have an LLC and you invoice me, et cetera, like you mentioned, but I give you hours, like, okay, let's take care of it in the next 2 weeks, come between 8 and 5 kind of thing.
That gets back into this thing. You're probably gonna be okay, but you want the case stacked in your favor as much as you possibly can. And once you're comfortable, and then the next step I would suggest is if you've got an attorney you work with or a CPA that you work with, go present them the facts and circumstances and have them put it in writing for you. Here, they described this circumstance to me, and I think as an attorney that this is a valid contractor relationship. Give you a copy of the letter, there's your defense. Yes, sir.
If you hire them and they are an LLC, do you still issue them a 1099?
Corporations, I mean, it gets confusing. We're gonna talk about 1099s in a minute. Some people get 1099s, some don't. And we'll get there in a second. It gets kind of confusing. Well, there we are. Okay. If you pay somebody for services rendered $600 or more during the year, theoretically, you were supposed to give them a 1099. Now, if they are a corporation, you're not required to give them a 1099. If you buy products from them as opposed to a service, you don't have to give them a 1099. Okay, how many of y'all accept credit cards? None? Okay, if you accept credit cards in your business, you get something that's a 1099K at the end of the year, which basically shows the total credit card transactions that went through your merchant account. If you pay a contractor with the credit card, and he accepts your credit card, let's say I paid this contractor $10,000 and it's all on credit card. His merchant account is sending him a 1099 for everything ran through that credit card. If I give him a 1099 again, he's having double income reported on his side. So now, used to you just worried about who you paid and how much you paid. Now you gotta worry about how you paid him. So if I paid a guy, let's say $1,000, and 600 was credit card and 400 was with a check, the 1099 I issued to this individual is only for $400. Because the credit card company, the merchant account, is putting the other $600, reporting that as income.
That'd be a 1099K.
He will get a 1099K for the 600, he'll get a 1099 miscellaneous from you for the 400. Very, very confusing. In fact, when that came out a couple years ago, I had an argument with one of my staff, and it's like, we were both on opposite sides. We were reading the directions, and the directions were like, you know, you could read the directions as you give one for the full amount, or you could read it the other way. So we ended up calling the IRS and saying, hey, what's the deal? Because it's confusing.
Is that the same for PayPal?
I don't know, I don't think so. To my knowledge, and I may be wrong, I don't believe PayPal puts out 1099Ks. So you're only worried about some paying them through a mechanism that the 1099K is generated.
So, but these are all, these are forms to claim, yeah, that service, right? I mean, you don't, I mean, everything else that's like a purchase and sale.
Right, those don't apply. This is only for service. So one thing that we see a lot is, well, clients will hire somebody as contract labor, you know, and they pay them a couple times, and this individual disappears. Comes the end of the year, you need to do a 1099, say, what's their name? It was Sam. What's the last name? I don't know. Where's Sam live? I don't know. What's Sam's social security number? I don't know. It's hard to issue a 1099 that says Sam. You know. So what you should do is get up front before you ever, and I'm telling you, in a perfect world, I realize perfect worlds don't exist, but in a perfect world, up front, you say, Sam, I cannot hire you to bring you as a contractor until you fill out a form W-9. On the W-9, Sam puts his name, his address, what kind of entity is he, a sole proprietor, an LLC, puts his social security number, puts the VA. He puts all the information that you need on that W-9 in order to send him a 1099 at the end of the year.
I have a question.
Yes,
I
sir.
started out as a sole proprietor and submitted my W-9 with my social security number, and then became an LLC. Do I retract that W-9 and fill out another one with the?
I would fill out another one. You don't have to, but I would fill out another one with the EIN on it to draw that distinction that my sole proprietor is over and now I'm doing the LLC.
For my taxing.
It all goes in the same spot on your tax return. Yeah. As long as you're taxed as a sole proprietor, it all goes to the same spot. But I would separate it out just to make that line saying I'm now an LLC. So if you don't get a W-9, or the individual refuses to give you one, my advice is don't hire them. Because why wouldn't they give you one? Also, there's something called backup withholding. That if you theoretically do not have a W-9, you're supposed to withhold 28% of what you pay that person and send it in to the IRS. Rarely ever happens. Just telling you what the rules are. So, and guess what the IRS does with the 28%? They have no clue who it belongs to. You know, because Sam didn't give me a W-9, so I'm keeping 28%. I'll never see Sam again because I kept 28% and gone. So I have to send the 28% to the IRS. All I know is Sam. Guess what? It never gets applied anywhere. They just think they're in the room. So it's best to get the W-9. Make sure you're dealing with reputable people. If they give you a wrong social security number, we see it a lot. You get a notice back from the IRS, says the name and social security didn't match up. Basically saying if you don't fix this, we're gonna make you do backup. So mostly by the time that comes around, the contractor's long gone anyway, so it's rare it creates a problem.
So how do you fix that? I'm sorry.
You get the right number from them.
Yeah, but how would you know until the end of the year when you did the W-9s or, I'm
You
sorry,
don't.
the
You don't.
W-1099s or?
They could say, here's my number and my name. It's 6, 9 months later after you file the 1099 before you get the letter back. So that's when you find out.
Wouldn't you wanna get an EIN number from them? So that we know?
If they are an entity, you want to get the EIN. If they're sole proprietor, you need their social security. I mean, you can ask for it.
Look at their card maybe?
You could ask to look at their card. They don't have to show it to you. An honest person probably would, but if you ask for my social security card, I'm not sure I can find it. It's in the house somewhere.
You're not supposed to get your social security card.
I haven't seen it since I was 15, I think.
Did you say that there was a 99 form, not the 1099, that you can file though? Did you mention that? I thought I heard something about a 99 form. Yeah, regarding if like, that you didn't get their information.
When
So, a 99 form, something like that.
Legal to work.
I-9.
An I-9.
Okay. That's, if you're hiring somebody as an employee, and you know they're gonna employ you, there's a form called I-9. It's a form that documents that they're legal to work in the US.
Okay.
So as an employer, you look at, show me your social security, your driver's license, your passport. There's a list of documents that you can accept to prove that they are who they are. That, if you don't have it on record, there's $11,000 fine, so.
That's what.
Okay. The department, this is while we're on that subject, because you guys will hire employees someday, the Department of Homeland Security has taken over the I-9 type process. We've had, I think, 2 clients where they come knock on the front door and they hold up a subpoena for the I-9s. And they walk in the door and you have to walk them straight to your I-9s and they look at them. So what we're told by attorneys, labor attorneys and different things, have your I-9s in a file all by themselves, not in the employee's personnel file. So if these guys come in the front door and ask for I-9s, that's their subpoena, you pull out a file with nothing but I-9s, and that's what they have the right to. If the I-9s are in the personnel file, you have to give them the entire personnel file. So generally, you don't want that. And we're also told when you have to sign the I-9 as employer, it says, I looked at these documents and they look valid to me. That's my summarization. If you keep the documents and they're obviously a fraud, you can get in trouble. So we're told, again, by the labor attorneys, if you don't have to have their driver's license, like truck driving companies, you gotta keep their driver's license, keep it in a separate file. But if they're just office workers or stuff, you're not, you sign that you looked at it and it looked good. Give it back to them, don't keep a copy, because the copy can only incriminate yourself. That's what we're told.
Don't keep a copy of your license plate, I'm sorry, your license number, or maybe your social?
The number, but not the actual card. Because if it's a false social security card, you and I might not know the difference. I guarantee you the Homeland Security people that are coming in would recognize fraud. They expect you to have known it's a fraud. So
And they'll fine us.
they will fine you, yes. as the employer, you will get fined. So if you don't have it, they can't prove that it's a fault. If you have to have it for the drivers, keep it somewhere else in other files. Someday, they're probably gonna require us to start keeping that documentation automatic. To my knowledge, right now, they don't. Y'all said nobody's got payroll, right? Okay. The moral of the story for payroll is if you do it, you have federal unemployment, you've got state unemployment, you've got Social Security, Medicare, federal withholding. Best thing to do if you're new and you don't understand it, go to a paycheck, go to ADP, let somebody who does payroll for a living do that. They're not that expensive. You know, if you wanna learn it, but make sure you got somebody to help you the first few times through. Tipped employees are even worse. So if you own a restaurant, you're gonna own a restaurant. Tipped employees, yeah, don't go there. We honestly, we don't work with restaurants from our firm for payroll because of the tips. I don't wanna deal with the constant hiring, firing, termination, the tips, the tip recordings, like, go somewhere else. I don't mean that negative, but. Let's see, we kind of talked about steps. Oh, this just reminded me. 1099s, historically, the contractor supposed to get the 1099 by the end of January following the year of the work. So for 2016, you need to have the 1099 to your contractor by no later than January 31st of 2017.
Right, what if they don't give it to you? What if I get them before April?
Yeah, I mean, that reality is that's how it works. Just do the best you can. Your job, though, if you report the income you were paid, you're done. You will not get in trouble for not receiving a 1099. They get in trouble for not sending you one. You're fine. You report the income you earn, whether you get a 1099 or not is irrelevant to you.
Because just because you didn't get it, didn't mean that they didn't get it to the IRS.
True, that's true. But see, they've had historically until April 1st or March 31st to get the IRS their copy. If they're filing electronically, if they're mailing it, they have till the end of February. So, what we generally do is give out 1099s to all the contractors, wait a month and see if anybody has a problem. Oh, we can then change it out. IRS hasn't seen it yet, right? We can change it out, get it fixed before it goes to the IRS. Starting this January, W-2, 1099s, all that reporting to the IRS has to be at the IRS by the end of January. I just saw that the other day and almost fell out of my chair. That's gonna be almost impossible for small businesses to comply with that. That just cut 2 months off the time that we have to validate those to get them right. So I'm gonna give you a 1099 by January 31st. I give it to the IRS a minute later. Next week, you come back and say, this is wrong. Now I gotta go amend what I've done with the IRS. It's gonna create a mess. So look, don't hire employees, don't hire contractors. Don't be a business. Just stay home and work on it. Okay. Okay, since you're not doing payroll, you don't care, but there's quarterly reports that go into the IRS, quarterly reports that go into the state. The money goes this way, the documents go this way, and the money goes this way based on how much money. I mean, it's really confusing, and it all eventually comes back together. And they want you to file electronically. Used to, you could do the payment coupons and take it to the bank, and they, no more. There's something called EFTPS, Electronic Federal Tax Payment System, that you can use to pay your payroll taxes, your income tax, all of that can flow through that system. And when you go to get an EIN or an employer ID number, they will automatically register you for EFTPS, and you'll get something in the mail. If you don't, you just log on to that EFTPS.com and sign up.
So if you're the contractor that gets the 1099 miscellaneous, you can pay your taxes with it.
You can pay your 1040, your 1120, your 941, all those taxes can be paid through it. You can't file the return, it's just purely
Oh.
money, just a money thing.
Oh,
Don't get excited.
I was just saying, wow, no more TurboTax for me.
Uh, I think we talked about everything on there. Let me just, well, y'all aren't doing payroll, just let somebody else do your payroll. There's so many problems. Okay, 2 additional taxes, I bet we're even early, early. Cool. Texas franchise tax that we kept saying, wait, we'll get to it. Personal property tax, we kept saying, wait till we get to it, but we'll get to it. The Texas franchise tax has nothing to do with a McDonald's franchise, a Dairy Queen franchise. We actually have people come in and think, I don't have a franchise, so I don't even worry about it. No, not quite. Is that what you? It's actually, when you boil it down, if you're a small company, it's very, very simple. So, it is a tax form. Nobody in this room is gonna owe tax, I hope you do.
I hope I do.
I hope you do, because it means you're making a lot of money. It's 2 pieces of paper. One that says, I'm here, and here's who my officers are, and here's where my office is. Another piece of paper says, my sales were under the threshold, and here's how much my sales were. And you're done. You just do that once a year. So,
That's for that $1 million.
if you're under the $1 million threshold, correct.
Per year.
Per year.
Yeah.
And you can do it online?
You can do it online. Go to the state controller's website, they have a way to e-file it. You need something called an XT number. XT with 6 digits behind it. You'll get it from the state controller in January, you'll get a letter.
Yeah, they usually send it when you file for your
So the franchise return is actually due May the 15th, not April, not March. So they do it so we have a deadline every single month of the year on it.
What does that cover, that franchise tax?
What does it cover?
Yeah.
If you made over $1 million,
Yeah.
then you have to pay another tax above $1 million.
Was there that previously $4 million?
You hope to make it over.
Part of the state still.
Yeah, if you make over $1 million, then you already filed, but otherwise, the tax, the taxes are going.
Now, the $1 million is not gonna be $1 million forever. When they first started this, it was 600,000. It's gone to $1 million. It can go down. The state legislator, when they meet every other year, can say, we don't have enough money, let's lower it to $500,000. Or they can adjust it. Right now, it's been at $1 million for several years.
Do you have to put the amount that you have a profit of and on that form, or
You have to
just
put your
the
growth, you have to
figures?
put your sales.
Okay.
So, I don't wanna complicate it too much, but there's total sales and Texas sales. So you could have sales in New York, which are part of your total sales, but they're not part of your Texas sales. So you gotta distinguish where your sales are. Very similar to the way you have to on
So
sales
this
tax.
is strictly just Texas sales?
These are just,
not out-of-state?
correct. So you can have 10 million or 100 million of out-of-state sales, as long as you're under $1 million in the state of Texas, you still will not owe anything.
And you only pay once a year?
Once a year.
Well, when I do my quarterly on the Texas Secretary of State, doing the filing, it's asking me franchise or franchise tax or whatever, and I always say no, because I didn't know McDonald's. But are they wanting me to pay quarterly on that also, if they think you're due? No?
If you're a big company and you're owing 20, 30,000 or more, then they like to see it a little different time schedule, but 99% of us was once a year.
Sign the rest of it.
So the due date is May the 15th. You can file an extension, which then puts the due date out to November the 15th if you If it's too hard to fill out those two pieces of paper in May, you can postpone it to November. If your sales are over $1 million, then there's different calculations, but the most basic one is your gross sales minus your cost of goods sold or payroll, which is required, times 1%. Not huge numbers, but we have clients that pay $40, $50, $100,000 a year in franchise tax just because they're large clients. And it gets more complicated if you have multiple companies that do business with one another. Because then you have to eliminate the intercompany business. Because if I sell something to her for $1 million and she sells something for me for $2 million, are we gonna show $3 million in sales? No, because it's all the same company, same owners, it's just going back and forth. So it gets more complicated when you're doing, you have multiple entities doing stuff back and forth. But it's nothing to worry about, it's really simple. Just don't forget to do it. If you don't file it, the state will, and it's a technical term, discombobulate your entity. Basically, take away your liability protection and everything you're trying to do will be forgotten. That's the franchise tax, pretty easy. Nothing to be scared of. If you miss filing, you don't file it in May like you should, you file in June, you didn't file an extension, there's a $50 penalty. Not the economy of the world. So again, it's not worth losing sleep over it. Okay, personal property tax. This is the one that everybody kind of turns their head sideways and goes, are you kidding me? Everybody that owns a home pays real property tax. You're familiar with the process. You pay it on your home. So you get a notice of appraisal in the mail. You've got time to go protest it. If you don't have protested, you get a bill that says here's what the bill's gonna be. What, October, November, sometime you get the real bill and you got for January to pay it. This works exactly the same, but it's on non-real property. So computers, desks, equipment in your company, all things like that are considered personal property. The Bexar County Appraisal District is the one that administers it. They send out a property tax rendition form. This is for you to rat on yourself, and you tell them how much you got. Okay, I got 6 cars, and you have to line them out. So a 42 Chevrolet, whatever. This is I bought a new computer. Or that's like your car. You line out everything that you got the first time through. The next year, they remember it all, and you mark out the things you got rid of, and you just add the new stuff. This thing is due April the 15th. Nobody's doing anything on April the 15th. This is a really good day to make another deadline here. And to be honest with you, I haven't filled out my rendition in like 3 years because I don't have time. So they just assessed me amount, I have 10% penalty. It's not worth it.
Is there any depreciation on the
They
equipment?
have their own depreciation schedule, so, yeah, if you bought something in 2012, they're gonna reduce the value each year based on their depreciation schedules.
And each county has their own.
I don't know how they depreciate, if they have their own schedules, it's probably common around the state, I would think. Because you can go down and protest, I've gone down and protested and won things, we got rid of this. Here's my real asset depreciation schedule. They want to see what's in your tax return. They'll work with you. You just got to go take the time.
Doesn't this take place though when you're doing your taxes? When you're filing for taxes?
Nothing to do with your income tax.
So this is just an additional tax?
An additional tax. We don't pay enough tax. We want to pay more.
You say it's a personal property owned by the business.
Owned by the business.
And not a forklift.
That would qualify.
That's not personal, it's the business.
Well, personal as opposed to real property. Again, the naming of it is confusing. It's not real property, so by lawyers, I think the term they use is it's called personal property.
So it would mean it's like the business property itself.
Yeah.
The computer.
Yeah.
The assets.
And every year you get to pay tax this year, next year, every year you own this stuff.
Is this like a deduction on?
Yes, on your
One.
income tax, this is the deduction.
So if I had my car, because I use it for work,
Mhm.
that's personal property, I get to write that off, but then I have to pay taxes on it.
And does the business own the car?
Where's my car, I'm in business?
But you're an LLC,
Right.
where's the title?
Oh, no, it's not.
Okay, see, I would take the stance that that's my car, not
Yeah.
the business's car. You might want to, if you're writing off mileage, that's a way to deduct your personal vehicle,
Okay.
um,
But not the whole car.
not the whole car. So I would take unless the title is in the company's name, I would take the position that that is personal and then do that. So, but it, again, this is not a huge number. We have, I don't know, in our office, our bill's like $250 a year. So it's not the economy of the world. Again, it's not something to be worried about, but I also have clients where they were, just, the county was repossessing everything they own because they did not pay this tax.
And you do it online, all of this is done online.
We get the renditions in the mail. Maybe they can do it online, I may be behind the times. But it's the Bear County Appraisal District is the one that's in charge of it.
So this really applies, I mean, the tax is really significant when you own a building or.
We work with trucking companies.
Trucking companies, yeah.
Every
It makes more
vehicle
sense.
they have, every trailer they have is an asset. They pay hundreds of thousands of dollars in this. For us, you know, I haven't seen it written. I've had people tell me that if your business assets are less than $600,000, don't even worry about it. If I was working out of my home, I'm not telling you it's a tax cheat, but if I was working out of my home at a home office, I wouldn't mess with it. They don't come find me.
And they will.
They would. They have their ways. Here's some tax planning ideas, and they're very, very simple. Number one, know where you are. This is where we tell people, keep your books current, because how do you know if you're gonna tax plan, do we need more income, do we need deductions, what do we need to do? We don't know unless we know where we are. So number one, know your current situation, that's using your QuickBooks, your whatever. Defer revenues, so easy, or you could bring revenues in, but most people want to defer and put taxes off, so we're cash basis, right? That's what we decided earlier, we're probably cash basis, so I'm looking at my stuff, and I'm going, you know what? I'm done. I don't want any more, this is killing me. I can call my customers and say, hey, guess what? Pay me in January, I'm cool. I know you owe me now, but if you pay me in January, that's okay. I just tax plan, I just moved revenue out of this year into next year. Very, very simple. As long as you're on the cash basis, it's very,
And then you
very simple.
click escort. Click escort for next year.
Accelerate your expenditures. So we deal with, like I said, the people that we work with that are heavy in equipment. We come around and do tax estimates for them October, November, and we'll say, you need to go buy 5 more trucks. You need to do this. Don't buy any more trucks. Whatever we're accelerating, decelerating, whatever it is to do tax planning with them. If you don't have heavy assets, go buy a new computer. Stock up on copy paper for the next. I mean, these are not big numbers, but everything you can do to either bring expenditures into this year or defer revenue, that's going to help you out. Tax planning can be a lot more complicated, but this is, most of what we need is not real complicated stuff. And where to get help? Surprisingly, the IRS has a pretty good website. I don't know if y'all ever gone there before, but there's a lot of stuff out there. That's us, we're up at 410 Callahan area on the north side. Come by, like I said, we got free coffee. 30 minutes, we'll sit down, 30-minute free, just sit down, ask all the questions that you want, we'll draw on the board, whatever. And,
Did you get calling where? 410?
We're at I-10 in California,
Oh,
just right north of 14. SBA, you got SCORE, Department of Labor, they retested, the girls retested all these links. They're still valid, we can go places to get information. You know, still even 99s and some of these forms. Department of Labor's a good place. W-9s and all that's the IRS website, but all the forms are easy, just type them in your Google search.
Sure, well, page one, you say they talked about, business development downtown on Alamo Street. Is there a website that I want to actually go there and get these suggestions and forms that?
Is it the Small Business Development Group out of UTSA?
No, I don't know. Anybody know about it? It's up by Alamo.
Do you know, Courtney?
Is that,
She's asking about small business development.
Yeah, the inserts that on Tuesdays were here for SCORE mentioned about, all the things you need, like, even legal forms you would need. You can go and tell them your business over on the, I don't know, 1400 South Alamo, I think it was. It's small business development.
I've seen that office before. Sound like on a corner?
I don't like to go because I didn't have time that day, but.
I thought the same thing. What do they do?
A website to ask the same questions and get the same forms without going there, finding parking.
Almost all government forms you can get, just Google them.
Yeah, government and legal forms, to make sure, like, contract forms.
The only organization I can think of that comes close to meeting what she's describing is the University of Texas Small Business Development Center, which has offices over on Cesar Chavez Boulevard, just west of I-10 there. And they also, SCORE considers them to be a competitor of ours.
It was 1906 South Alamo, the Economic Development Center of San Antonio. Some guy named Hugo Villarreal.
He works here.
That's the city office. Yeah, that's the city office at 1901 South Alamo Street. Hugo Villarreal is the small business officer down there. He publishes a magazine called the San Antonio Small Business Resource Guide. And he's on the first floor of 1901 South Alamo Street. He also is here. I didn't finish my whole spiel. I left some things out.
We got time to go for it.
Okay. I told you a little bit about SCORE. We are in Cafe Commerce, and I told you before, this is not part of the San Antonio Library. This is a separate entity owned by the city of San Antonio and managed privately by a corporation known as the Fund. They are actually a bank of sorts. Okay? But they cooperate with SCORE. I forgot to mention this earlier. I told you that SCORE offers mentoring services. One of the places where we offer mentoring services is right here in this building, in this space, on Monday through Thursday. We have mentors here Monday through Thursday offering free mentoring services. I am the Saturday mentor. I mentor every Saturday here at the San Antonio Public Library between 12 and 4. Of course, I'm getting out of that today by being here. So the Small Business Development Center, as I said, is perceived to be a competitor of ours because they also offer free business mentoring services at their headquarters down there on Cesar Chavez Boulevard. And they have other locations as well. That's their main office. And then the city that she's talking about has this business development office, which is headquartered down there at 1901 South Alamo Street. But Hugo Villarreal, who is the small business officer there, comes here every Thursday. He has office hours here in this room back there every Thursday. So he has lots of answers to your questions. Hugo and I used to counsel small businesses together. In fact, I brag that I have taught him everything he knows about mentoring small business. Our desks were right next to each other through 2006 to 2009. So I could go over to his office, I could steal one of those booklets, and I could give it to one of my SCORE clients. Now you can get them online by going to www.sanantonio.gov/SBO, which stands for Small Business Office. And when you get to that landing page, you will see a picture of the business guide over on the right-hand side. You click on that, form comes up, you fill it out, send it back by email, and Hugo will customize that report for the type of business that you type in on that line, where it says type of business. He will customize that report for you and email it back to you. And you will get a customized report of most all the rules and regulations that you need to know about doing business in San Antonio, and some state offices as well. For example, sales tax, where you go to register your business, things like that. That's all in that little booklet. He won't give you the detail on taxes that David did here today. We love David. David does a wonderful job talking about taxes.
What is that website for interaction with Mr. Villarreal?
www.sanantonio.gov/SBO. Oh, Small Business Office. www.sanantonio.gov/SBO. And when you get to that landing page, you'll see a diagram over on the right-hand side. This is where it used to be last time I looked. It looks just like the cover of the booklet. Click on that. A form will come up. You fill it out. And on the line where it says type of business, be as specific as you can, because Hugo is going to customize that booklet for that kind of business that you type in there. So if you're in construction, or if you're in transportation, or if you're a consultant or whatever, you type that in there, and whatever rules and regulations the city of San Antonio has that govern your business, Hugo will highlight those for you in that publication. We used to be able to give that away for free, but the city has stopped incurring the publishing costs. So now Hugo provides that to you as electronic publication. Our SCORE's main office is over in the Federal Building on the corner of East Houston and Alamo Street, right across the street from the Alamo. The Federal Building where the post office is on the first floor. We are located up on the second floor with the Small Business Administration. SCORE is very closely tied with the Small Business Administration. Our National Association gets a grant each year from the Small Business Association. Or I'm in administration, pardon me. I didn't make the clients make that same mistake I just made. I apologize for that. It's the Small Business Administration. And so we're located up there with the SBA on the second floor of the Federal Building. Then we have this location here where we offer mentoring during the week. And then on Saturday afternoons, you'll find me upstairs on the 5th floor in the conference room between 12 and 1. I see a couple of my clients right here. Is there anybody else here who's already a client of SCORE? Raise your hand. Okay, good. Then you should be contacting the mentor who helped you to get an appointment to go back and see them. And for the rest of you, I would like to have you fill out this form. Is it your plan?
Yes,
No.
sir.
seen you here before, but you're not a client yet. But you are a regular at our workshops, aren't you? So please fill this out and leave it here with me. And we will contact you and set you up an appointment with one of our mentors.
And I have another question.
Sure.
So when you're doing mileage and for change of vehicles and things, do we have a choice like we do in some instances on the income tax to do mileage or, save on the receipts? So we still have that choice?
You still have that choice. What you don't want to do is jump back and forth. Pick one, stick with it. Generally, if this is a very general rule, if you drive 10,000 miles or more per business, you're generally going to be better off sticking the mileage on. If you drive less than that, you know, but you're a high percentage of business, then you probably do better with the depreciation than the actual expense. The depreciation is what really helps you on the actual expense side.
There's an app for that, will photograph the receipt and it'll take the information and put it into a spreadsheet. I can't remember the name of it right now, but.
There's I tried those apps for like tracking the car mileage and stuff.
Mhm.
But if I walk too fast or if I rode my bicycle or something, it's tracking all of that. And it's like,
No,
you know,
this
I
is,
couldn't turn it off when I wasn't in the
this is
city.
for like your gas receipts and you input the mileage and then it inputs it into a spreadsheet, so.
Okay. But there's so many options of different ways to do things. And generally the first time through, or every time you get a new automobile, you can change. But if you were to go from mileage, then you want to go to actual expense, then go back to mileage, there's rules to do it, but it's not real advantageous.
There was one point that David was talking about, well, lots of points that he was talking about, but as I was standing back there listening to it, it occurred to me that perhaps one point of clarification is that when you register your business as either an LLC or a corporation, you're doing that with the Texas Secretary of State's office. But the rest of but then when you go to apply for an S corporation, that's a relationship between you and the IRS only. It has absolutely nothing to do with your registration of your business with the state. You got to keep those two things separate. Nobody has to apply for an S corporation if they don't want to. David told you all the benefits of it, which are great. But it's completely different than registering your business.
I had heard before that the LLC is defaulted to a S corporation with the IRS. Is that correct?
No.
No, I've never heard of that.
Okay.
It defaults to either a sole proprietor or partnership. If you want to be an S corp, you actually have to actively go file something.
Can I ask you another question?
Sure.
When you were talking about the depreciation, that was for new equipment. What if you purchase used equipment? Is it a lower, do they take that in?
It's just a lower starting point for
Okay.
depreciation. It starts with what you paid for it.
Okay, excellent. All right. Thank you very much.
And then one thing, I guess, we're having, for some reason, a rash of our clients are hiring out-of-state people. And I know none of y'all did payroll, but if you do, and if you hire somebody from out of state and they're working from home, this one came up yesterday in Kentucky, like, okay, that's great. Now we've got to go register your company in Kentucky so that you can do Kentucky income tax, Kentucky workers' comp, Kentucky state unemployment. You know, you got to. So when you start hiring people, if you hire people out of state, keep in mind it's going to cost you some money and some headaches.
Even if you use like a union or something, say, you have to just register as an employee there.
I would think if you're still the employer, I would think you would still have to register and do all, if you're doing the payroll. If you're using the ADP or something, they'll register for you and take care of it. So they're going to charge you. Because registering out of state, some of them are cheap, some of them are expensive. Every state's different.
Is the same complexion with a contract service out of state?
I don't think so, no. Contract service, you don't have to worry about because you're not responsible for withholding their taxes and all
On the 1099s.
Okay.
Like if I have a business and my husband, I own the business, my husband can work for me.
Correct.
And I can pay him.
Yes.
I can send him, well,
You don't want, I would not send my spouse a 1099.
no, but we have to file separately because I own the business and he has to file, pay taxes on the
If-
named
if-
on people.
If you're a sole proprietor, you still file, married filing jointly. Almost always, it's gonna be advantageous to file jointly, even if you have a business.
Even if I have an LLC and he works for me, he does all this construction work for me and I write him a check to him
Right.
for working for
Because
me.
if you're filing, you're married, this is all community property state, you're filing jointly, your income is his income and vice versa. So there's unlimited transfers of money between you and him. It's when you go outside the family that you start to get, if you hire your kids, then you need to pay them. That's your issue if you want to pay your kids. Aunts, uncles, anybody, but spouse, you're okay, but outside of that, then you need to pay them something.
You still, but like he's saying, I mean, the 1099 miscellaneous, you still have to pay taxes there, portion of that
I mean,
contract price of,
yeah, you end up paying the tax for what he's doing for you.
you pay the income tax, and you still have to pay his social security and his Medicare tax.
Yeah, it depends on how the business, if the business is 100% under you, all the income's reported under you, whatever you pay him is not deductible. So if you want him to pay part of that self-employment or get social security credits, then you could give him a 1099.
How about take care of it himself?
Mm-hmm.
And he just mentioned something important. If he wants to get social security credits,
Exactly.
which is important.
Yeah. That's what I did. I know my mom took care of my kids at one point. I paid income tax and social security for her to get quarters in order to get me,
Mm-hmm.
in order to start getting social security. I had to pay her. She took care of my kids and I paid social security for that. So she had to meet so many quarters.
See, there is a, social security stops at, what is it, 115, you remember what, 100?
Credits.
No, as far as when you have to pay into social security. So like, my taxable wages that I'm contributing social security, I believe it's 115,000. I could stop paying social security tax in a year once I make over that. We have couples that work together and they'll stack their income in a sole proprietor so that all of the income is reported under one spouse, so that they will exceed that social security limit in order to save on social security. So if you each made $100,000, you're paying social security tax on $200,000. But if you stack you're only paying social security on like 115, and the other 85 you're not. So there's
Yeah, but it's per person.
per person, correct?
It's
It's
per
who gets
person.
the credit though.
Right, so
Yeah.
I mean, if she's an LLC, she probably wants to give her husband the credit.
Probably. Most,
Because she looks really young, you
Yeah.
know?
yeah.
So you still want to have it separate.
But some people, they go, no, I want it, you know.
But if you're happy with his social security future income,
Then nothing.
then.
If it's there, and,
So many of the young people we see don't think far ahead. They're going, there's not gonna be a social security, just ignore it. And they're done thinking about it. The older people, they're very serious about, I wanna make sure I get this, I wanna make sure I get that, because they're planning on saving their money. It's crazy.
And when you say, to do it
Here's
separate,
the-
are you
here's the
talking
form right there on the
about
back table, and I'll pick it up.
jointly
Thank you very
married,
much for coming.
or?
You can file, because we're dealing with two separate types of taxes. You can file jointly on your income tax. But you could have a business, sole proprietor, which you get half the income, you pay your husband half, you're both paying social security. It's still all on a joint tax return. If you have one form that says he made this much for social security, you got another form that says you made this much. So you're both getting your social security credit.
Oh, so then you have to do two returns, one
Oh, it's-
married and
it's
then one for the
still-
business.
It's two 1099, I mean.
Is that what you mean?
It's one return, but it's got two schedules inside of it. One, for Schedule SE, which breaks out the self-employment income between how much is hers and how much is her husband's.
Oh, okay, that's what I'm missing. Because-
I may not be explaining it right.
Yeah, no, yeah.
Thank you, everybody. Appreciate y'all coming.